Good afternoon. The market spent all of June terrified of the wrong thing. Everyone was braced for the Strait of Hormuz to close, for oil to spike to $100, for inflation to force the Federal Reserve to raise rates. And now, one holiday weekend later, oil has quietly exited the danger zone, crude is sitting in the high 60s, and the whole doom loop has flipped from war premium to a supply glut. Meanwhile, stocks came back from the long weekend and bought chips with both hands. Into the exact week, a top Wall Street strategist says semiconductors are set up to correct. Records on one screen, warnings on the other. Let's get into it. Here's the board intraday. The S&P is up about 0.7%, back in record territory. The Nasdaq is leading, up more than 1%, dragged higher by chips. The Dow is the laggard, roughly flat, which tells you this is a narrow, top-heavy tape. Gold is bid near 41.75. Bitcoin is the softest major, down about 2.5% to the low 60,000s. Crude is easing towards 68 on glut fears. And the 10-year Treasury yield is slipping to about 4.46%. The bond market's quiet vote that the hawkish case is thinning. Now the signature segment, consensus versus the read. First one, everyone thinks artificial intelligence is a chip bet. Buy Nvidia, buy the memory names, done. But look at the actual money. The four biggest cloud companies will spend around $725 billion on artificial intelligence infrastructure this year. That is up 77% in a single year. And the multi-year figure being modeled is more than $7 trillion of build-out through 2031 across compute, data centers, and power. The chip is the part everyone charts. The durable rent and the hidden risk lives in the infrastructure and financing layer. That is today's deep dive. Second read, everyone thinks the Federal Reserve's next move might be a rate hike. Oil just voted the other way. A soft June jobs report, just 57,000 jobs against expectations near 110,000, knocked September rate hike odds from about 66% down to 50% in a single print. And crude flipped from war premium fear to glut fear, the single most disinflationary input in the economy, rolling over just as everyone braced for the opposite. The next inflation surprise is more likely to be down than up, and a hawkish market is not positioned for it. Third read, everyone thinks crypto is rolling over. Bitcoin can't hold 62,000, and the headlines write themselves, but the plumbing disagrees. Coin is leaving exchanges, big blocks moving off venues to unknown wallets, against more than $135 million in fresh stablecoin minted. That is dry powder building, not a demand collapse. And the cycle everyone's panicking about is upside down. This drawdown is about 51% from the October high versus the 78 and 84% wipeouts that define the last three bear markets. It feels worse only because there was never a euphoric top to fall from. Here is the tell, the single most revealing number of the day. $725 billion, up 77% in 1 year. That is the fastest corporate capital spending spree in history. And this week, for the first time, the market stopped clapping at the spending line and started asking about the return line. Semiconductors just had their worst two-day stretch in months on exactly that doubt. The spending is still accelerating. The question of whether it pays off has finally been asked out loud. Follow the money. The Federal Reserve under Chair Kevin Warsh is still leaning hawkish. The live debate is a possible September hike, not a cut, but the ground is shifting. That weak jobs print was the first real crack, and the minutes from the last meeting land this week. Governor Waller drew a hard line, saying the Fed will not keep rates low just to help the government finance its deficits, an explicit rejection of political pressure. On the other side, gold sits near 41.75 on a soft dollar, easing rate hike bets and steady central bank buying. The bond market and gold are both quietly betting the hawkish case is fading. The market's actual catalyst today came from Washington. For the first time, a president rang both the New York Stock Exchange and Nasdaq opening bells from the Oval Office, launching Trump accounts, a $1,000 Treasury seed for every American child born through 2028. Read it as a structural retail flow story fused with political theater. A government-seeded equity vehicle is a slow, durable bid under the market. and on the sentiment side. Our market and social monitoring shows the same split as the tape. Soft prices, but positioning and flows that lean toward quiet accumulation, not panic. Sectors in play: semiconductors. The bull case is a real memory supercycle, with South Korea's chip giants reporting this week. The bear case is that Morgan Stanley's Mike Wilson sees semis setting up to correct. The tape is buying chips into an event a top strategist wants to sell. Energy: cheaper oil is a disinflationary tailwind for the whole economy. Watch whether the glut holds crude in the high 60s. And crypto: this is a fundamentals over narrative regime, where accumulation flows fight a confirmed structural seller in the Ethereum Foundation. On the radar, this week, South Korea's chip earnings put the artificial intelligence memory thesis on trial, and amiss is the asymmetric risk. On the 7th and 8th, the NATO summit in Ankara, with a Trump and Zelensky meeting set for the 8th, after Russia's overnight strike on Kyiv killed at least 11 people. Any ceasefire headline moves defense, energy, and gold. And this week's Federal Reserve minutes will tell us how seriously the committee is taking that labor market crack. For the scorecard, 3 new calls on the record. 1. The oil regime flip pulls the inflation path lower, so September rate hike odds do not climb back above 66% without a genuine re-acceleration in services inflation. 2. The artificial intelligence infrastructure and power complex outperforms the pure memory chip makers over the next 2 to 3 quarters. And 3. Despite soft prices, crypto's on-chain flows stay net accumulation rather than confirming a demand collapse. We date them and we grade them. So here's the question worth sitting with. The market treats the artificial intelligence build-out as a spending story, and every quarter the spending gets bigger and the stocks go up. But spending is not a return. The 1 week the market finally asked what comes back, the chips had their worst 2 days in months. So watch the danger zone the crowd isn't watching. Not Hormuz, which just cleared. The gap between 725 billion going out and whatever's actually coming back. That's the Daily Brief. Today's deep dive is linked right below. This is Earl, one contrarian read a day. Subscribe.